Good morning, I'm Amy Botinsky. I'm Chief Marketing Officer at Zillow, and I'd like to welcome everyone to the Forum on the Future of Housing. On behalf of Zillow and our event partners, the Progressive Policy Institute and the American Action Forum, we are so thrilled for all of you to be here today. Thank you. So today we've brought together an esteemed group of national real estate experts, lawmakers, economists, and thought leaders to help all of us get a clearer picture of what the near-term and long-term future holds for America's housing market. Zillow is the leading online real estate information marketplace. More than 50 million people use Zillow every month on the web and on our mobile apps. Our mission as a company is to empower consumers with information to fuel them in what is often the most emotional and the largest and most expensive purchase of their entire lifetimes. And our mission with all of you in this room is to be an information resource to you, America's thought leaders and policymakers on housing. So we are so excited to have you here today and to kick off our forum. I also want to mention that Zillow sponsors the quarterly home price expectation survey with our partner Pulsenomics. Each quarter we asked more than 100 of the nation's leading economists, real estate experts, investment and market strategists to predict the path of housing, to predict the Zillow Home Value Index over the coming 5 years. And if after today's forum you have any questions you would like to be added to our next survey, or you'd like to participate in our survey, please approach me or one of us here at Zillow. And one last note for those of you who are on Twitter today, because I know this is a social bunch, our hashtag is HousingFuture, and you can see it at the bottom of your booklets there on your chair. So now I have the distinct privilege and honor of introducing today the Honorable Johnny Isakson, Senator from the state of Georgia. We are so fortunate to have him here in our forum today. Senator Isakson began his career in 1967 when he opened a real estate office in Cobb County, Georgia, and went on to serve as president of the largest independent residential real estate brokerage in the Southeast. He was elected to the United States Senate in 2004 and serves on the Senate Finance Committee. I think any of you who follow housing closely will know that there are few members who are as knowledgeable on housing policy as Senator Isakson, and we are so excited to have him kick off our forum today. Please welcome Senator Isakson.
Well, thank you very much. I'm delighted to be here to talk about the future of housing. You know, the last 5 years I've been asked to talk about the future of housing, and I've always said it's pretty lousy. It's pretty lousy because values have depreciated by 33% since their peak in 2006 and 7. House sales were down, inventories were high, and we're really having a lot of trouble. Well, I'm here to tell you that housing's back, and housing's recovery is bright, and the future is bright for housing. But as to whether it's a 40-watt bulb, a 60-watt bulb, or a 100-watt bulb, depends on the United States government and getting our policies right for the future, because there's some fundamental changes that have taken place in the mindset of the American buyer and the American home buyer, and some fundamental changes that have taken place in the regulation of the mortgage industry and the regulation of the finance industry. It is critical that we have a way to finance our recovery, or we will not recover. Today's sales are more robust than they've been in 5 years around the country, and most of those sales, a lot of them, are all cash, or the buyer is a pristine, credit-worthy buyer. But the middle of America, good credit-worthy buyers, but maybe not as high as 720, people that have a down payment but can't pay all cash, have a very difficult time financing because of the uncertainty of the regulation of the finance market and because of the fears that people have of the finance market or the ability to borrow at all. So what I'm going to try and do this morning for a few minutes is talk about some ideas that I think will help us to get from where we are to where we need to be in terms of financing and government regulation and construction, and then open the floor and try and answer any questions that you might have. As all of you know, Freddie and Fannie have a tarnished image. They have a tarnished image because of what happened with the subprime securities that collapsed in 2007, 2008, because of the number of people that lost their homes because of what happened in the housing market. But Freddie and Fannie really were a victim of the United States government policy. Pardon me. We directed them to buy a certain percentage of their inventory and hold it in terms of affordable housing loans. Those became subprime loans, which became B, C, and D credits, which became poorly underwritten loans, which went bad. And when they went bad, the securities that had been guaranteed by Freddie and Fannie went bad, and AIG's credit default swaps got called, and we had a cataclysmic collapse of housing finance and available capital going to the housing market. We have got to replace that by learning the lessons of this collapse that we went through. And what are those lessons? We didn't have a down payment recession. We had an underwriting recession. We got too loosey-goosey in terms of loans we would underwrite and exotic type loans. I remember when my kids would come home in the middle part of the first decade of this century and say, "Dad, I can borrow 100% with only 10%, with only 2% interest for 10 years, or I can borrow and have negative amortization on my loan to get my payment down, but my loan balance goes up over time, or I can have an exotic low teaser rate, but it goes up 2% every year for 5 years," or some kind of crazy concoction. I said, "Don't do it. It's too good to be true. My father and your grandfather told me when I was growing up, son, if it looks like it's too good to be true, it probably is." Well, it was too good to be true, and we paid a terrible price for it. But we should not pay a terrible price in the future by not fixing what we did wrong, learning from the error of our ways, and restoring the U.S. housing market. Because the key to bringing unemployment back to 5%, which is considered basically about full employment, is to get the construction industry back, and the way you get the construction industry back is to get housing back. If you don't do that, you're still going to have an unacceptable rate of unemployment. You're still going to have 2% growth rather than 4% per quarter growth, and you're still going to be in sort of a malaise like our country is today. Pardon me. Now, how do we do that? First of all, we've got to replace Freddie and Fannie. One way we would do that is, first of all, change the name. And I've made a proposal, which I'm going to outline for you, which I think is an idea that has some merit. In fact, I think Mr. DeMarco this morning is testifying on Capitol Hill, and will refer to some of these suggestions as things he thinks ought to be done in terms of restoring Freddie and Fannie in the mortgage market. Number one, we got to realize Freddie and Fannie have a tarnished brand, and no matter how much you try and polish that brand, it's still tarnished. So we need to put them in a conservatorship and let them wind their way out. We need to create a new agency to replace them, a single agency. I call it the Mortgage Finance Agency. And its role should be to guarantee well underwritten mortgages, because that was the problem. Freddie and Fannie got into guaranteeing poorly underwritten mortgages. Now, what is a quality underwritten mortgage? I'll tell you what it is. I want to give Mr. Cordray at the Consumer Finance Protection Bureau a big kudo. I was not proud when he was paid an appointment and a recess appointment. I didn't like having an agency created that was outside the purview of Congress. I didn't like what was done with the Consumer Finance Protection Bureau, but I have to give Mr. Cordray credit. He assembled a bunch of experts. He listened to the private sector. He figured out what underwriting should be a quality mortgage, and he put in rules and regulations that I think match what I'd like to see us do in terms of the Mortgage Finance Agency. Pardon me, pollen just kills me in the spring, so I apologize for the coughing and the sneezing. What he basically said is he took the ratios that we used to do in the 70s and 80s for underwriting and put them in place for a quality mortgage. 43% ratio of total debt of a year or longer, including your monthly payment, to gross income. That's a reasonable debt-to-income ratio that makes sense. Secondly, he did away with 100% financing, teaser loans, negative financing, negative amortization, and said you have to have a down payment of at least 5%. You have to make your monthly payments, and you can't have exotic interest rates and teasers, and you can't have gimmicks. And in that case, he's right, and that's what we need to do. So that's the first step. Create a new agency that guarantees loans that are well underwritten. Let them be securitized and packaged to attract the capital to the mortgage market, and let it be governed by an independent board and run like a business, not like a government bureaucracy. It is critical that we do it. Now, one other thing we've got to do is also minimize the risk that the government guarantees. When the government was guaranteeing risk before, they were guaranteeing sometimes 100% value, because that's what the loan ratio was. That's unacceptable. What we ought to do is require a minimum 5% down payment, and then a credit enhancement of private mortgage insurance on the amount above 80% up to 95% of the loan, so you have 20% protection for the guarantee. And then add a protection by requiring 30% supplemental insurance on the amount of the loan from 80% to 50%, so the government's risk ratio goes from the full amount of the loan to half the loan, or 50%. And then to top it off, you take the GSE fees, the G fees, and after using those to pay for the operation of the new entity, put them in a sinking fund for catastrophic first call if the guarantee is ever called on. If you do that, you will protect the new agency from ever having the catastrophic problem that Freddie and Fannie have had in the recent time. Think about this for a second. In the Great Recession, the value of housing in the United States of America went down by 31%. That was in the Depression. In this recession, it's gone down 33%. It's recovering, it's coming back, but it went down to 33%. That was the risk level. Freddie and Fannie were guaranteeing loans up to 100%, so they got called on a big guarantee. If you're covered down to 50%, you're never going to get a call if the maximum decline goes down to 31 or 33%. So it's important to understand we've got to protect that guarantee by requiring down payments, credit enhancements, and supplemental insurance. I apologize again for the pollen. I sat under a tree at the Masters for 2 days last weekend and absorbed all the pollen in South Georgia. If you do that, and you ought to have a next goal with that agency, its goal ought to be to privatize itself at the end of 10 years, if need be, so the government gets out of the guaranteeing business. And I would submit to you, if you create a new agency that's got insurance to protect it down to 50% of the guarantee, only guarantees well underwritten, pristine type of loans like Quality Mortgage provides for, and collects the catastrophic sinking fund to be the first call on the guarantee, you will have an entity the markets would love to privatize, love to take private, and would love to buy. But you've got to demonstrate over a period of time, and I think it takes 10 years to demonstrate that and do it. So that's what my solution is. Create a new entity that basically does what Freddie and Fannie do, change the name and change the image, make it an underwriting agency that makes sure they're underwriting they're guaranteeing well underwritten loans, and have an exit plan over 10 years. That makes sense, and that would attract the capital back to the housing market. Now, the second thing we've got to do is get the government's attention. We're now in a recovery that's being limited by the regulators. The Quality Residential Mortgage Rule, which has been pending since June the 20th of 2011, is still pending. We hear it may come out any day. If it comes out the way it was originally proposed, by saying every loan with less than 20% down payment has to have a 5% risk retention held by the lender, will be a non-starter. Ms. Baer, Sheila Baer, when she was at FDIC, proposed under the QRM rule that everybody had to put at least 20% down, did not count private mortgage insurance for that guarantee or that credit enhancement. That will not work. And what you'll have is the middle market in America, 60% of the buyers who need loans up to 90 or 95% won't have financing available to them because no lender is going to guarantee or put in risk retention 5% of the principal amount of a loan and hold it until maturity. It just doesn't make any sense. It's too big of a capital requirement. What we hope they'll do is just merge QRM with QM, be silent on the down payment requirement, have good underwriting standards like QM has, and go away from the QRM rule entirely. That's my hope, and that's what I hope will happen. Third, this may surprise you a little bit, but immigration is an issue. We don't have the workers to build the houses in a robust recovery. We've got to have an immigration fix for skilled and unskilled workers at the housing level, whether it's roofing, whether it's foundations, whether it's footings, excuse me, or whether it's brick masons. We have got to have a better, more robust type of immigration in this country, or we're not going to have the workers to build the houses in a robust recovery. Lastly, I think we should recognize that attitudes are changing in America. Housing is being restored in terms of confidence. More Americans are wanting to go out and buy, but still are timid and tepid about buying again because of the depth of the recession. The better we can handle the financing of housing in this country, the more robust we can make financing, the better we can reform the regulation, the more confidence will return, and the quicker the mortgage market, the housing market will come back to a robust recovery. So my message to you today is simply this. We are recovering, and the future for housing is bright. The difference between a 40-watt bulb in brightness and a 100-watt bulb in brightness is getting our regulations in order, restructuring Freddie and Fannie to attract capital to the mortgage market to fund the recovery, and to see to it that we have an immigration policy in this country that allows us to have the workers necessary to build the houses for the recovery. I apologize again for the pollen. I'm happy to be with you today. I appreciate the invitation by Zillow, and I'd love to try and take your questions if you have any. Yes, sir.
So, if I understood correctly, in your proposal, the sort of 50 to 80% attachment of the insurance would come from private sources. So what I'm
Correct.
curious about was what happens if we have another crisis, hopefully a very long time from now, and we have those insurers go bankrupt like so many of the monolines did in the last financial crisis. So what's your vision for what happens to housing finance in that kind of situation under your proposal?
Well, I would submit to you that if you had an underwriting quality like QM, if you had the guarantee down to 50% of the face amount of the loan because of the supplemental insurance and because of the private mortgage insurance, that you would not have the type of cataclysmic housing recession that we experienced in 2007 to 2011, or the one we had in the Depression. That's my answer to your question. You always run the risk of bankruptcy. You always run the risk of the economy going sour and people going out of business. We don't know what the next bubble is going to be. Some people say it's student loans. Some people say it's other things. But I would submit to you that if we recognize what got us in trouble, that was shoddy underwriting of lending, getting the government to guarantee that lending, that's what got, if we fix the underwriting standards so that the government's guaranteeing well underwritten loans. Richard Smith will tell you from the panel, and he told me this morning, default rates right now in the United States of America are less than 1% on residential mortgages. Historically, great numbers are 2%. So defaults are 50% of what they used to be when they were great. That's because all the borrowing right now is either no borrowing at all, paying all cash, or pristine credits making the mortgages. If we get the middle America well underwritten and the government guarantee insured by supplemental insurers and private insurers as well as private mortgage insurance, then you're right, our only risk is that those people go broke or go bankrupt. But that would be a risk after the homeowner couldn't make the payments because they'd lost their job because we were going into recession and it fed on itself. And that's a risk that business has to normally take in at any point in time. There's always a possible cataclysmic event that could cause you a problem. But I would submit to you, if they're well underwritten, if they're guaranteed and insured, and if they're done with a catastrophic fallback fund like I was talking about, you probably would not have that happen, or the chance of it would be so remote, it is a reasonable risk to take. Yes?
Mortgage servicers have to deal with about 41 different foreclosure laws, and in some states, because of court backlogs or whatever, it's taken somebody goes delinquent when they're actually foreclosing a couple of years. And as a result of the severity of loss to the person who owns the mortgage can be 70, 80, and even 90%. Do you think that along with the new National Mortgage Agency, you should also have any loans that it guarantees subject to a national foreclosure law?
I think we've got an overly regulated problem in terms of the lending industry where they're scared to make a loan because of the many places they could make a mistake in the paperwork and the documentation, like the assignment problem that took place when the Big Five finally made a settlement. A seamless law nationwide might make an awful lot of sense from a standpoint of that standard, just so everybody knew what the rules of the game were. But you know, what's happened in the regulatory end is the regulatory agencies on financing are treating a broken arm like a heart transplant. You know, a broken arm, you need to fix it, you need to put a cast on it and let it heal. But a heart transplant's a whole lot more complicated. They're making mortgage lending more complicated than it ought to be, and they're putting lenders at such risk they just say it's not worth the effort. And so I would submit that if we get our underwriting standards well done, like we talked about in QM, if we had a seamless standard for mortgages and for mortgage servicing and the like, that we probably would be better off. So your suggestion makes a lot of sense, because right now, a lot of people just aren't making loans because they don't want to expose themselves to the potential risk or the clawback that they could get from the regulatory agencies because of a mistake that is technical in nature and not criminal by any stance. I'm sorry, I have my back. Yes, over here.
My name's Patrick Tadian with BNY Mellon. I wanted to ask you what your thoughts are on the right level of home ownership in the United States. I mean, clearly, at one time it was thought to be 70%. Obviously, that did not work out well. What do you think the right level is, and also what's your view on home rental versus home ownership?
Well, I'm prejudiced on that question. I'm going to tell you up front, I sold houses for 33 years. I never saw a time where it wasn't a good time to buy a house. And quite frankly, now is a great time to buy a house, any of you that are in the market, because you better get on the train while it's leaving the station, because it is leaving the station. But I was telling somebody in the green room a year ago or 2 years ago, I had a great fear. In my career in real estate for 33 years, it was generally accepted that the average family, American family, during the course of their marriage bought 5 houses. A starter home, a move-up home, a statement home, a second home, and a retirement home. Because of the depth of the recession and the loss that took place, that children experienced and families experienced, I worried that fully 2 of those purchases were going to be taken out of the plans of them in the future, which would be, over time, a 40% reduction in demand if people removed 2 of the 5 purchases the normal family would normally make. I don't necessarily think it's that severe now. But without the ability to finance middle America, without the ability to have a regulatory environment that is understandable and fair enough for lenders to make the effort to make mortgages, you're not going to have the demand you had pre-2006. The 2006 and 7 demand was somewhat fueled by subprime lending, BC and D credits, people who couldn't borrow being able to borrow. I love Jim Johnson. He's a great guy when he was at Fannie Mae, but he wrote a book called Showing America a New Way Home, which basically ended up reaching into markets that weren't prepared to borrow money and pay back mortgages. And that's where a lot of the defaults came. So if we get back to quality underwriting, if we get our regulations fair and precise for the American people, but not so overly burdensome that people won't make loans, then I think we can recover to a reasonable percentage. That was not going to be 70%, I don't think. Is 65% the right number, or 60? I don't know, but it's probably somewhere in that range of 60 to 65%. It's always better to own than rent. The difference in the United States of America and every country in the world is we're a nation of owners, and most of the rest of the world is a nation of tenants. I've been a tenant when I was a college student, and I know what I did to the apartment I rented. And I've been a homeowner with a wife for 46 years, and I know what I do every time I go home in the weekend. I do honeydews. And the house looks one heck of a lot better than that apartment that I lived in college. And that's kind of the difference in ownership and renting. And that's not to disparage a renter. That is human nature. We all take more care and better care of what we own than what we borrow. So what the right number is, hopefully it'd be 65%, 60 or 65%. It's not going to go to 70, and we've learned the lesson of what you do when you take it to 70. If we do the quality underwriting like we talked about under the Cordray rule, I think we won't get to that percentage of home ownership, because underwriting in and of itself would prohibit it. But we'll have a robust market because those that will be qualified will be able to borrow. Yes, sir.
Jack Masinko from SIG. Clearly your proposal has a fair amount of reliance on private mortgage insurance. I'm wondering what your thoughts are behind the capital levels in that industry. Do we need more providers? Are the capital levels adequate for the proposed idea? And then also, if I could get your thoughts on the future of the FHA in that, in sort of the framework you've laid out. Thanks.
Well, second question first. FHA is carrying too big a burden in the housing market. I don't know what the percentage is today. Somebody in the room does, but about a third of the loans being made right now are FHA loans, because there is no robust middle market because of the underwriting standards and the regulatory standards. So FHA is carrying a disproportionate amount of the burden of housing finance in the country. So their future, I hope, will be better because we do fix the Freddie Fannie problem and bring more conventional money into the mortgage market that doesn't require FHA to make those loans. Now, I know what I know about and I know what I don't. I don't know a lot about insurance reserves, capital reserves, and what's good and what's bad. So I'm not going to try and guess at something that I don't know. But I will tell you what experts have told me when I've made my proposal and introduced it in Washington. There's a firm in New York called Capital Alpha, and they're a think tank that on the insurance industry and other financial. They think that not only would the private mortgage insurance market work under the plan that we proposed, but also that there would be a robust number of insurance companies trying to come into the marketplace to provide the supplemental insurance. Now, that doesn't address the capital requirements, and I apologize, I don't know what a good number would be. But it does tell me that experts in Wall Street, who are rating agency type of experts, think because of the quality underwriting standard that you put in, that the insurance industry would be attracted to writing that risk because it would be a marginal risk at best because of the double layers of protection. Yes.
Senator Dan Crowley with K&L Gates. I want to follow up on both of those questions and ask, given that FHA is really the private sector counterpart to private mortgage insurance, in the context of FHA reform, is there a role for risk sharing with private mortgage insurance on FHA loans?
Is there a role for that?
I'm wondering if we can help reform FHA by risk sharing with private mortgage insurance.
Well, I think there's a role where that could take place, whether or not the market would be, the private insurance would be attracted to doing that. If you mean them being a backup to the FHA, I don't know, but insurance usually is available if the price is right, and how much that would cost, I just don't know. I do know that my proposal would raise the cost of closing for a borrower because you would have a second premium for the supplemental insurance, but I think that's a reasonable cost to pay for a robust available mortgage money.
I was actually thinking of your proposal of putting private mortgage insurance in front of FHA insurance. Take the first.
That would take a big burden off of the FHA. There's no question about that. And I would think, again, if the price was right, there would be an attraction for the private mortgage industry to do that. Anybody else? Yes, sir.
Will Marshall, Progressive Policy Institute. I was very intrigued by your proposal for a single sort of GSE. So a political question, do you think your folks on your side of the aisle, you could rally support for this kind of proposal?
I was hoping that question wasn't going to come up.
Privatization is deferred for 10 years, so who knows?
Well, as I have told them, you take it private now, it won't go private, and there'll be no middle market for housing. And if they think they've had a bad recession now, just look out. I mean, we've got to fix this problem. We're living on borrowed time because people that have cash are buying, and because people with pristine credit are borrowing. But that's not a robust recovery. That's a recovery where people are using their own capital to recover. Over time, leverage has always made real estate work, and if there's no leverage available for middle America, there's not going to be a robust recovery, and we could have a second dip in my particular judgment. I have the greatest respect for Mr. Garrett, Mr. Henschling, the number of people I've been making one-on-one calls for 2 years. Richard Smith knows this on the House side, trying to explain to my colleagues why their goal is right. You get the government out of guarantee and stuff. But that's a phase-out situation that you got to have a demonstration project that works. It's not an automatic legislative decision that you just say we're out of the business. Because if you do that, you're going to cause a second dip. I'm making some progress. Probably one of the brightest minds in the United States Senate's Bob Corker on finance. Bob and I differed, not at each other, but over this proposal for a while, but he's moved towards what we're talking about here as well. So we're picking up cohorts in crime, so to speak, going along. I'm convincing some people to take a second look. Speaker Boehner has taken a favorable look at what we're talking about. And I would hope if the administration would recognize there is probably $100 billion in debt or deficit reduction sitting on the table if we can get Freddie and Fannie fixed on an annual basis. If they would recognize that the 2% recovery in the first quarter, if it was 2%, I don't think it was even that high, could be 4% if you brought back housing, then maybe we could get that done.
Senator, in the middle here.
Middle.
Hi.
That's where the bright light is. So I can't.
Hi, sorry. You mentioned immigration as one way to deal with labor shortage for the industry. I'm wondering, with the high unemployment rate and high unemployment rate, particularly among veterans, if the government had thought about also setting up some sort of major training programs to bring people into the industry on the trade side.
This is another area where the government's not doing a very good job. You happen to ask me about something I'm supposed to know something about. I'm the ranking member of the Workforce Investment Subcommittee of the Labor Committee in the United States Senate. Patty Murray from and I got 1 minute to go, and I'm watching your sign. I can see that, so the hook is here, so I'm gonna have to shut up in a minute. But the Patty Murray from Washington and she's the chairman, I'm the ranking member. We have drafted for the last 5 years the Workforce Investment Act for its reauthorization to address precisely what you're talking about, and it's died for 5 years because labor really wanted more provisions in it to be more labor friendly than private sector friendly, and they've stalled along. We ought to be doing more in terms of workforce development and government programs that already exist to train people for the jobs that now are there. Now, granted, 5 years ago those jobs were dissipating and not growing, but they're starting to grow now. We don't have the masons, we don't have the footing folks, we don't have the roofers to do the job. If we can get Workforce Investment Act reauthorized in the Congress of the United States this year, the workforce investment boards in the various states can begin demonstration projects to go to these unemployment offices and bring in people who need the skills training, get them trained for the jobs. With that said, the zero's coming up, so I'm going to shut up. I deeply apologize for the pollen, but there's nothing I can do about it. I'm just a Georgia boy that's allergic to it, and this time of year is tough. I really appreciate Zillow asking me to be here today. I really hope some of the answers have been helpful, and I look forward to being with you part of the rest of the day. Thank you.